I think you put it right. This is largely a valuation call. So I want to be clear. Apple, we wouldn't argue with anyone who says Apple is a great company. We think that their AI strategy is a very sound strategy. I love the appeal of the fact that Apple has a low capital intensity approach to AI, that they have the trust of customers, and on and on. They have a lot of advantages. No one would dispute that. But it's trading at 33 and a half times earnings. And one way to think about it is just think about the PEG ratio, if you will, the ratio of growth rate to of the multiple to growth rate. It's trading at a PEG ratio north of 3. The rest of the Mag 7 trades at a PEG ratio of around 2. So you're talking about a 50% premium even to the peers within the Mag 7. That just doesn't make sense given what are some very material risks.
In a recent market analysis, Moffett downgraded Apple stock, triggering discussions among investors. Craig Moffett explains the rationale behind this decision, citing concerns about valuation, antitrust pressures, and Apple's position in the Chinese market. This summary breaks down Moffett's arguments to provide investors with a comprehensive understanding of the risks and challenges facing Apple. Before we delve into the video, if you want the latest crypto news, market updates, and expert insights from the top minds in the industry, be sure to hit that subscribe button and turn on notifications. Stay informed, stay ahead, and never miss an opportunity in this ever-changing world of the financial market. Thank you for subscribing to our channel. Moffett begins by acknowledging Apple's success and strong market position, which has driven its valuation to substantial levels. However, Moffett argues that the current valuation may not be sustainable. He suggests that much of Apple's stock performance has been driven by factors that may not continue indefinitely, such as increased service revenue and successful product cycles. Let's listen to what Craig Moffett have to say about Apple stock.
I think you put it right. This is largely a valuation call. So I want to be clear. Apple, we wouldn't argue with anyone who says Apple is a great company. We think that their AI strategy is a very sound strategy. I love the appeal of the fact that Apple has a low capital intensity approach to AI, that they have the trust of customers, and on and on. They have a lot of advantages. No one would dispute that. But it's trading at 33 and a half times earnings. And one way to think about it is just think about the PEG ratio, if you will, the ratio of growth rate to of the multiple to growth rate. It's trading at a PEG ratio north of 3. The rest of the Mag 7 trades at a PEG ratio of around 2. So you're talking about a 50% premium even to the peers within the Mag 7. That just doesn't make sense given what are some very material risks. And you mentioned some of them. China is a very real risk, not just because the Chinese government, for obvious reasons, is going to be disinclined to allow Western language models in China. So you're going to have a domestic partner and share economics with them, but also because the Chinese handset competitors have gotten much stronger. Another risk that is not discounted in the stock price at all is the antitrust risk. And here I'm not talking about the antitrust risk in the cases against Apple, although there are plenty of them. The real antitrust risk that's very proximate is the risk in the Google case. Where
explain that risk to Apple. How is Apple at risk?
Because 25% of Apple's operating income comes from payments from Google. And the judge in the Google case has specifically said those payments are illegal. Now, you can imagine that there are outcomes where they still pay some or all of that, but you can't pretend that there's no risk at all when the judge has already said that Google is guilty and the payments they make to Apple are illegal. I mean, that's 25% of Apple's operating income. It's $25
Massive.
billion a year.
So,
and so the point we were making in this morning's downgrade, and again, I love Apple just as much as everybody else, but there are very real risks that are simply not appropriately discounted in the multiple that Apple is being awarded right now in the market. Well, I think the biggest thing that's going on in China is that the other handset manufacturers Huawei and Honor and so on have gotten much better. If you went back to the last big iPhone cycle, which was the 5G cycle in circa 2021, the Apple competitors at the time were significantly weaker than they are today. And interestingly, Huawei in particular, because the government of the U.S. Put sanctions on Huawei and limited Huawei's access to chipsets and that sort of thing. Huawei's had to sort of reinvent itself with domestic technology, and they've done a really good job. The handsets that they make are now fully competitive. They are not a replacement for Apple. I'm not suggesting that they are, but they have a really competitive offering. And so the market share opportunity for Apple is simply not what it was in the last big cycle. But you also have this time the government's thumb on the scales. And there's a couple of ways for that. One is, as I said, you're simply not going to have the Chinese Communist Party saying it is acceptable to have Western LLMs answering questions like what happened at Tiananmen Square. So you're going to have domestic partners in order to be able to offer AI. And that means a different margin structure and what have you. You also have a very real risk from tariffs. And it's not just, in fact, not even primarily, that Apple itself imports almost all of its components, and in fact today it imports all of its handsets mostly from China because they're assembled there. Even if they are exempted, as they were during the last Trump administration, you have the risk of retaliatory tariffs in response to American tariffs that could be related to the auto market or completely unrelated categories, but where foreign governments respond by putting tariffs on a company that is obviously quite highly identified with the US. Mm-hmm. So again, I don't want to suggest that any of these risks are base case risks. It's not like there's a 60 or 70% chance that any one of them will happen. But if you have all of these potential risks, all of which shouldn't be described as sort of a tail risks, these are really real possibilities in all of these cases that there are negative outcomes. And they ought to be reflected in the multiple of the stock with a more sober multiple, and they simply are not. This is really a valuation call, but look, the market overall is pretty frothy valuations, but Apple, even relative to the Mag 7 peer group, is now extremely stretched with a PEG ratio of around 3, where the rest of the Mag 7 trades with a PEG ratio of around 2. So there's this perceived safety in Apple. Wonderful franchise, very dedicated customers. But there is no safety when you're paying 33 times earnings for a company that's growing organically in the very low single digits, and even with buybacks, earnings are still growing at sort of half the rate of the rest of the Mag 7. We're not saying Apple is a broken company. I want to come back to some very real risks that we should talk about. But Apple's not a broken company. It's a broken valuation. And there are, as I said, some significant concerns that ought to be reflected in a lower multiple, or at least a more sober multiple than what you've got right now. There was this narrative over the past couple of months, particularly into the last couple of weeks of last year in 24, where everyone was talking about the fact that Apple was, quote unquote, melting up in the face of no news.
Craig Moffett's downgrade of Apple is based on a combination of factors, including high valuation, antitrust pressures, and a weakening position in China. While Apple remains a strong company with a loyal customer base, investors should be aware of these risks and challenges. The analysis suggests that the current valuation may not be sustainable, and that Apple's future performance may be more muted than in the past. Investors should carefully consider these factors when making investment decisions about Apple. By understanding these potential headwinds, investors can make more informed decisions about their portfolio allocations and risk management strategies.